Hi everybody, Thomas at Rebel Income. Mining for value in the stock market means that sometimes you have to be willing to look in places that might not seem to make sense. In an environment where persistently high interest rates have helped to push consumer prices on everything from a carton of eggs to the shoes on your feet higher, a retail stock might fit that description. The problem with taking the assumption that all retailers are going to struggle in this kind of environment at face value is that consumer demand has been just as stubborn as the Fed's determination to keep interest rates high. That's not categorically good news because rising interest rates raise prices throughout the supply chain all the way through to the consumer. That's why a lot of retail companies have seen their stocks underperform over the last year or so. It's also where the occasional diamond in the rough can be found. You might not be familiar with VF Corporation, but you're probably familiar with one or more of their brands. Timberland and the North Face outdoor recreation apparel and footwear, Dickies workwear, and Vans deck and skateboarding shoes may be their most recognizable names, but they're really just part of a product portfolio that runs all the way from shoes and clothing to handbags, backpacks, and luggage. This is a stock that has been falling for the last 4 years after peaking in January of 2020 at nearly $100 per share. The drop has been so severe that the stock has fallen completely off the radar of most growth-focused experts. But a deeper look into the company's latest data and their price action shows that this radioactive stock might actually offer one of the best opportunities in the stock market right now. Before we dive into the details, I want to take just a minute to invite you to check out my Rebel Income Patreon page. I publish daily exclusive access content on this page, from stock reports detailing my analysis in search of the trades that I publish, for my trade alerts, to lists of underpriced dividend-paying stocks, and even weekly recordings discussing current open positions as well as current market conditions. You'll find the link in the description area for this video. Take a look. I know you'll find something that you'll be able to use in your own trades. My preference as an investor and as an analyst is to focus on dividend-paying stocks that I think offer attractive value. So I want to start by taking a look at the dividend for VFC. This is a company that's paid a dividend for a number of years. Right now, their annual dividend is about 36 cents per share. At their current price, that means that their annual dividend yield is a little over 2%. One of the important elements about the dividend is the fact that they have cut it over the last year on 2 different occasions. For a lot of investors, reducing a dividend is a sign that a company is in trouble. It may be a reason to completely ignore the stock altogether. I think that the devil is in the details when it comes to matters like this. And context is everything when it comes to understanding management's reasons for making changes to their dividends. In the case of VF Corporation, the reduction in the dividend coincided with the suspension of a stock buyback program management chose to take on in order to pay down their high long-term debt levels. The important question about the dividend where it currently stands is whether or not they're going to be able to sustain it in the face of the conditions that the market is generally dealing with, as well as those high debt levels. That's why on this chart I have the dividend shown on the right side at 36 cents per share per year, along with the company's earnings per share over the same period of $1.22. Comparing a company's actual dividend payout to their earnings per share gives you a dividend payout ratio. Dividend payout ratios are useful in trying to analyze the sustainability and quality of a dividend. The higher the dividend payout ratio is, the closer it is to being in line or possibly even above their total earnings per share, and that makes a dividend harder to sustain over time. VF Corporation has actively reduced their dividend while earnings per share have also been declining in a difficult economic environment over the last 2 years. However, at their current level, the dividend payout ratio is only a little over 0.25. In other words, the dividend is less than 25% of the total earnings per share. That's a strong indication that the dividend at this level is healthy and sustainable. Now, with that in mind, let's take a look at what the stock's current price action is doing. I mentioned earlier that VFC stock has been dropping for just about all of the last 4 years. The chart here shows the last year of price activity. We can see that the long-term trend is clearly still moving down. Although the good news is that in the last few months, the 200-day moving average has begun to flatten out just a little bit. This could be an indication that the long-term downward trend could be at a point where it's ready to reverse. More interesting and more useful for our purposes is the fact that over the past several months, the stock has formed a stable support level at around $15 per share. And in fact, we can point to not just one, two, or even three, but four different points where the stock has approached the $14 to $15 price range, stabilized, and then bounced higher. The latest bounce has happened just in the last couple of days as the stock has begun to pick up some positive bullish momentum that pushed it above the 20-day moving average, and it's now approaching about $18 per share. Now, if the stock can push above $18, the next question is, where is it likely to find next resistance? The stock looks like it could have upside to nearly $24 based on some pivot high activity seen in May last year, just a little bit below that level. So we'll go ahead and call that $24 per share. From a reward to risk standpoint, that means from the stock's current price at about $17.50, there's about $6.50 of upside against about $3.50 of downside. That's a reward to risk ratio of not quite 2 to 1, which means this is not an ideal technical setup right now. However, if the stock does push above the 200-day moving average at 18, your reward to risk ratio in that case goes to $6 of up against less than $1 of downside. And that could be very attractive as a very near-term opportunity if you're looking for a short-term trade. Even with that interesting technical setup, I think that the real story about VF Corporation is in the long-term opportunity. Let's take a look at their fundamentals. Over the last year, VFC's free cash flow has staged a significant reversal from minus $722 million a year ago to its current level, a little above $1.2 billion. And we can see a steady pattern of improvement over each of the last 4 quarters, from minus $722 million to minus $209.4 million to $166 million to the current level, a little above $1.2 billion. In addition, the company's cash and liquid assets have also improved in the last quarter from a little under $500 million to $988 million in the most recent quarter. Now, that is a reversal of a pattern of declining liquidity, as we can see from $814 million a year ago to the $500 million level 2 quarters ago. So that reversal in a positive direction is also an encouraging sign. I mentioned that VF Corporation reduced their dividend in part to begin to pay down long-term debt. A year ago, their debt was a little over $5.7 billion. When you compare that against their overall cash and liquid assets, you can see that they were and still remain very highly leveraged. However, they have paid down almost $1 billion of that long-term debt over the last year and now have a little over $4.7 billion in long-term debt remaining on their balance sheet. Still have a ways to go, but they are making solid positive progress in paying down their long-term debt. Management has indicated they will resume stock buybacks and consider increasing their dividend once that long-term debt has paid down a little bit more. Another very encouraging sign from a fundamental standpoint is the way that the company's overall operating profile has begun to improve. The way that I like to measure this is by comparing net income to revenues. And over the last 12 months, we can see that net income was negative 7% of revenues over the same period. That's negative net income, implying that the company has been spending more money than they are bringing in. However, in the most recent quarter, this metric increased to a negative 1.43%. I take the overall improvement, even though it is still negative, as a generally positive sign. And this is a way to confirm the improvements that we are seeing in free cash flow and overall cash. When you put all of this together and you throw that against the backdrop of the stock's long-term trend and its very depressed price at around $17.50, it begins to make sense that this stock is significantly undervalued. In fact, my own value analysis suggests that the stock's fair value price is actually just a little bit below $72 per share. And before you think that maybe this is an unattainable price given the distance that it represents from the stock's current price, this is a range that the stock was at as little as 2 years ago. The downward trend since then is significant. However, considering the overall pattern of improving fundamental strength and its currently depressed stock price, this projected upside of more than 300% actually looks reasonable. For all of these reasons, I consider VFC to be one of the best bargains in the market right now. Thanks everybody. I hope you found this information to be useful. If you like my content, please go ahead and click here to subscribe to my channel. You can also click here to see an example of the other kind of video content that I put on this channel on a regular basis. Thanks for your time. I'm Thomas. Talk to you again soon.